Let's go. Welcome to the first ever episode of The Property Show. My name is Rachid Alawi, and every week I'll be cutting through the headlines, dodging the fluff, and giving you the real picture behind the luxury property sector. What's selling, what's stalling, and what no one else wants to say out loud. Whether you're buying, selling, or just scrolling through Rightmove for sport, you're probably in the right place. So what's the mood right now? Cautious. That's not just in central London, but globally. But someone clearly forgot to tell the ultra rich, because sales over 20 million jumped 25% last quarter. Why? Simple. Smart money moves early. And whilst most of us are sitting tight watching interest rates and headlines, the ultra wealthy, mostly cash of course, are anticipating future value. They know the best deals often happen when everyone else is nervous. For them, prime property isn't just a home, it's a store of wealth. In fact, Knight Frank's Prime Global Cities Index, which tracks movement in prime residential prices across 44 global cities, rose just 2.8% last quarter. Doesn't sound like much. It's actually the strongest result since last year. Still well below the long run average though. So what's holding things back? It's certainly not demand, but possibly confidence. And the one thing that everyone's watching is interest rates. Talking of which, a big announcement this week.
The Bank of England announced that it had cut interest rates. They have been cut from 4.5% to 4.25%, a fall of 1/4%.
So nothing overly dramatic there, but certainly heading in the right direction. Policy committee was split. 5 voted for the cut, 2 wanted to go even further and bring the rate down to 4%, and 2 said hold. Thankfully, no one was pushing for an increase. Now, it might not change much for cash buyers, but the good news is it does send a message. Inflation is softening, the direction of travel is clear, and confidence, as we know, is half the battle. So the cut may not spark a buying frenzy, although it is a psychological boost. However, inflation doesn't just impact buying a house.
McDonald's has been hit by its first fall in global sales since the start of the pandemic in 2020, as lower income consumers struggle with the cost of living.
When people start thinking twice about the affordability of an extra value meal, you know things are getting pretty bad, although I'm sure the McDonald's leadership team are staying positive.
Even the CEO admitted it was too expensive.
So the Standard this week came out with an article claiming that the exodus of millions recently could be as damaging as losing 1.5 million taxpayers.
London's super rich are taking a one-way private jet trip out of here. New data shows that London has suffered a bigger exodus of the super wealthy than any city in the world except for Moscow.
Yes, you heard that right. For those that don't know, on the 6th of April this year, the new non-dom tax rules came into effect. The new legislation states that it doesn't matter where your money is or where you earned it, you'll pay UK tax on worldwide income. Now, what that means, for instance, is that if you're a UK resident and you happen to have a holiday home in Spain, or let's say a tech business in Germany, you'll be legally required to pay tax on those gains. So why is this, in my opinion, such a counterproductive move by the government? Well, besides everything, the timing of it couldn't get worse. The UK is trying to attract international investment post-Brexit, whilst dealing with high inflation. We have a cost of living crisis, a huge budget deficit, and the government's answer to all of this is let's drive ultra high net worths out of the country. It doesn't make any sense, not to me anyway. And just as you heard, in just the last 6 months, over 11,000 millionaires have left the country. That's 1 every 4 hours. Now, that's not just a symbolic loss. Each of these individuals was contributing on average around £400,000 in income per year. So in effect, it's like losing tens of thousands of regular taxpayers in 1 quarter alone. And if these wealthy individuals are leaving the country, they're much less likely to be buying properties, and of course, less transactions means less stamp duty. So in effect, the HMRC and UK government are generating less revenues from property taxes. So joining us today to discuss the true impact of this new taxation reform and the effect it's having, particularly on the super prime property sector here in London, we have Igor Griskin, the Chief Executive Officer of Griskins. Am I saying that correctly?
Yeah, Griskin, my own surname.
Griskin, there we go, there we are. Now you specialise in helping ultra high net worth individuals find property in London. Is that a fair description of what you do?
High net worth and ultra high net worth, I don't discriminate between.
You don't discriminate. And by the way, Igor, I've got to say, I love your style and I love all your social media content.
Thank you.
And the tattoos. I wouldn't be brave enough, but Igor, out of interest, how do clients react when they see you in the flesh and see your stunning?
Listen, I've been having tattoos since 2014, and most recent one you can see on the neck. But some people might like it, some people don't like it. But there's people who might find it offensive. Probably I wouldn't do business with them regardless. It's just no synergy. So, I get to choose the clients, and clients also get to choose who they want to work with. So,
fantastic.
There's that.
Now, talking of clients, I understand that a couple of weeks back you were working with a very important client, one that had a budget of 20 million. I understand that you made a fair amount of traction in finding the right property, but something happened, right? And it's directly associated with this new tax reform for non-doms. Care to tell us a bit about what happened?
Yes, a couple of weeks ago, a referral has landed. I've got this buyer who was very much interested in a sort of branded service residences within London. We identified one of the most prestigious buildings within London. We decided that this property was a great fit. We made an offer. We managed to agree it. About a week into compliance, KYC, onboarding, after buyer started looking into tax implications, and then after the call with a private banker, he's been advised against the purchase. And it's not just because of the property or the price, it's simply because of the politics. What I mean by that is the current, obviously, non-dom abolition for someone who is the CEO of a very large company and not being a tax resident within UK and operating from Dubai, having an asset in the UK can lead to some substantial tax implications, especially if they're running any business meetings or even Zoom meetings from UK jurisdiction. Therefore, this deal deemed not to be a wise investment.
So hold on, let me just get this right. So if you're a resident abroad, in this instance Dubai, you own a property in the UK, okay, which you're allowed to do. Overseas buyers are eligible to purchase property in the UK. If you happen to be conducting any sort of business in the UK, based on the fact that you have a residence in the UK, you could be liable for tax. Is that the advice?
If you don't have a residence in UK and you have a residence in Dubai, but you're conducting the meetings or Zoom meetings within UK jurisdiction, it could trigger tax implications on overseas income.
So on the back of that advice, what happened?
So on the back of that advice, the perfectly structured deal essentially collapsed, because the investment and the strategy to have a property down in UK could lead to extreme risks of about half of the global income, which is currently, I think, 45%.
Igor, can I ask you a question? Was the property that you'd managed to secure, was that to be purchased off a developer or was it a resale?
It was off a developer. It was perfect property. No problem.
Okay, so this is a UK, presumably the developer is a UK business, correct? I mean, you have to be.
Yep.
Okay. And roughly speaking, I know you can't sort of go into too much detail about the figure, but we're talking about sort of a purchase in the region of 20 million, correct?
So from tax, if you're thinking about what tax implication of sort of contribution to
So that's
UK
what I'm
budget,
getting to. So exactly, that's what I'm getting to. So what would have been the stamp duty on
summed
that?
up to £3.5 million
Okay.
loss to the UK government.
Okay, so the
One purchase.
HMRC would have made around 3.5 million, and then the developer would have made sort of I don't know, 20-30% profit margin on that purchase. So again, so you've got taxation on the buy side, the taxation on the sell side. I mean, pretty good all round for HMRC, right?
Single deal as well.
Single deal. So there you are. One of the reasons why I have no idea how this new taxation system is made it through, and the true impact that this has for the UK economy. Igor, thank you so much for joining us and
Thanks for having me.
Giving us an insight, and I'll see you soon. Take care. But having said that, it's not all bad news. Thanks to Trump and his antics, US applications for UK citizenship has hit an all-time high. Whilst wealthy Brits are leaving, wealthy Americans are moving in. In the last quarter of 2024, nearly 12% of overseas buyers in central London were from the US, overtaking Chinese buyers for the first time ever. Why? Well, it's not just the exchange rate, it's politics. With Trump back into the White House, wealthy Americans are looking for bolt holes abroad, and many are choosing London. Tom Ford reportedly spent £80 million on a mansion in Chelsea. So it looks like we're exporting the wealth on one hand whilst importing it on the other. Moving on, let's go through this week's power plays. 3 Kings Yard, a boutique development in the heart of Mayfair, where one apartment has already sold for £5,000 a square foot, has now completed after 2 years of construction. I actually sold a flat next door to none other than an American buyers. Sotheby's have launched a new family office division exclusively for billionaires. Heading it up is none other than Marcus O'Brien, no stranger to prime central London and luxury real estate. Marcus and I are actually joint agents on a beautiful house in Wadham Gardens, Primrose Hill. So Marcus, if you're watching, maybe log into that database and help us agree this sale. By the way, there is a link to that listing on Wadham Gardens below. So not one, but 3 prime residences at 9 the Millbank, including the penthouse, just sold for a combined 50 million, making it a major moment for Westminster's luxury property scene. The 3 included the Astor, a 10,000 square foot unit, the Conrad, which boasts a spiral staircase, and a 98-foot terrace, and the Gainsborough, poorly designed elegance. Of course, massive kudos to Will Pitt, a good friend of mine and the deal maker behind the scenes, who called it a privilege to represent such one-of-a-kind homes. In other news, Reuben Brothers unveiled the first homes at the £1 billion development in Piccadilly. After a decade in the making, the Reuben Brothers have officially launched 1 Carrington, tucked behind Shepherd's Market. The boutique scheme delivers 28 new luxury homes with Natalia Meyer interiors, design space kitchens, a wraparound penthouse with views. Prices start from 2.95, and the most expensive apartment is 12.95. Underground parking, 24-hour concierge, and a private members club. Of course, the Carrington just opposite. Knight Frank and Beecham's are handling the sale and are seeing a lot of the international demand. With very little in terms of build stock in Mayfair, I guess the timing couldn't be better. Of course, gutted not to get the instruction on that one. But on the other hand, I have been mandated for 1 Park Place Villas, a home with serious history, once owned by the Duke of Sussex, Michael Flatley. Asking price 25 million. It's on the market with myself, the listing and the link is featured below. Also this week, officially mandated on a turnkey white stucco house near Belgravia, overlooking the Garden Square, priced at 11 million. Full details dropping shortly. Meanwhile, DDRE is going from strength to strength, welcoming Robert Austin and Oliver Venn to the fold, making it a team of 50. DDRE's global chief executive, Daniel Daggers, told Prime Resi it's incredibly rewarding to see top advisors worldwide drawn to DDRE. Little disclaimer, I do work for DDRE as well. So that's it for this week. Next week, we're getting into what's really happening in the market, how to get your property ready for sale, and an exclusive peek at the £11 million listing in St. George's, which I'm bringing to the market. And if you found that useful, please like, share, and subscribe. My name is Rachid Alawi, and this is the Property News Show. See you next week.